man.
He's the man.
With the mortgage plan, save you time, save you cash. Get that mortgage in a flash. He'll custom plan your strategy, show you how you can live mortgage free.
Mark Goode.
He's the mortgage man.
He's the man.
With the mortgage plan, a Mark Goode deal is a good deal better.
Today we're going to be talking about refinancing or debt consolidation. This seems to be a hot topic over the last little while. More and more families have higher consumer debt than we had in the past. Right now we're going to try and take advantage of the historical low rates. The idea is to borrow the money at a low interest rate on your house and pay off higher consumer debt, which is usually credit cards, loans, or student loans, things like that. If you have equity in your home, it makes sense for us to reborrow at a low interest rate and pay off some of these higher interest credit cards. Not only does it lower your payment per month, it also lowers what you're going to be paying over many years in regards to interest. It'll also make it a little bit easier for you to get by month to month. We can also use the money for other strategies. You can use it for RSPs, put it into different types of savings events and different things. You can also buy multiple houses. And this is what people are doing to try and grow their wealth. You borrow the money at a low interest rate and you obviously make more money than what you're paying obviously on the interest. Today we're going to be talking about the difference between a variable rate mortgage and a fixed mortgage. This is a very hot topic, not only amongst institutions, lending institutions out there, but the broker community, as well as the hot topic around the dinner table. A variable rate mortgage is actually a mortgage that actually fluctuates with prime. Most lending institutions will actually discount this based on what prime is and then the discount below the prime. On a fixed mortgage is actually the rate is locked for the remainder of that term. So if it's a fixed rate mortgage for 5 years, that rate is actually locked for a 5-year term. Basically what we would do is we'd sit down to determine what your needs are in regards to the actual mortgage, and that will determine or help us determine if you should be in a fixed rate mortgage or in a variable rate mortgage. The facts in the past have been basically that fixed rate mortgages have been better for usually first time home buyers or people that are on a fixed income and can't have an influx of a mortgage rate on a particular month. In regards to the variable rate mortgage, 91% of the time over the last 35 years, you've been actually better in a variable rate mortgage than you have been in a fixed rate. The difference between the two usually runs at about 1.5% difference, being that the fixed is usually running about 1.5% higher. In the long term, this saves you on a $150,000 mortgage. On average, it saves you about $30,000 in interest alone. This is the reason why we actually will sit down with you, determine your need and what your critical factors are. If we would be putting you into a first-time home buyer situation with 5% down, we probably would recommend the fixed. If you're a sophisticated individual that has lots of equity in your home and maybe have 2 incomes coming in and the fluctuation of payment is not a big deal for it, if it went up a quarter point or so, we'd probably be putting you in a variable rate mortgage.
Mark Goode.
He's the mortgage man.
He's the man.
With the mortgage plan, save you time, save you cash. Get that mortgage in a flash. He'll custom plan your strategy, show you how you can live